Okay, welcome back. We've got the market, which is 7 points lower, 25,940 is where we are at. Nikhil Ranka is with us, Chief Investment Officer of Equity Alternates at Nuvama. Nikhil, great to have you back on the program. Thank you very much for your time. You're cautious. Let's put it straight up. And for a variety of reasons, from F&O positioning to the new thing, which is maybe China looking a little better at the margin. I think your view is that you'd watch flows, foreign flows, very closely over the next couple of weeks or so, whether all the stimulus, etc., is attractive enough to get foreigners to buy that market. Is this a very near-term view, Nikhil, or you think overall for a while the market needs to consolidate?
So good afternoon, Prashant, and thanks for having me on the show. If you look at near term, what has clearly happened is if you look at the weightage of India and China in the MSCI Emerging Market Index, both India and China have been close to 20% weightage. But if you look at the trailing 12-month FII inflows into both the markets, China has seen outflows of $92 billion, whereas India has seen inflows of close to $17 billion. So a lot of fund managers, the emerging market fund managers, were running an underweight position on the Chinese market. And that has played out well for them. Now with the Chinese government giving stimulus, acknowledging that the market needs some sort of support, yesterday we saw Chinese markets have rallied 4%. They have moved up again today, and valuations are less than 10 times CY25 for the Chinese markets. So my sense is if there's more strength in the Chinese market, a lot of the foreign portfolio managers will be forced to increase allocation to Chinese market. And that would mean that India could have lesser share of foreign inflows as we go forward. If you look at it, in terms of positioning also, the last 1,000 points move on Nifty that we have seen, there has been almost close to 30,000 crores of buying on the F&O side and another 30,000 crores of cash market inflows that we have seen in the FIs. And yesterday was the first day where we had a large sell figure from FIs after a long time. So yeah, we will have to watch this situation very closely. And the second point is, even by historical standards, if you now look at the valuations of Indian markets, we are now close to 21 times FY26 earnings, whereas the median multiple has been somewhere close to 19.5 times. So we are a bit therefore cautious on the near-term outlook, and we will want to watch the FI flows in the markets for the next fortnight very carefully.
Okay, so yeah, take your point. Let's see what happens to those FPI numbers, because we haven't had very consistent flows come into India anyway. Let's see if that number starts getting negative or not. But Nikhil, to sort of talk about our market on its own merit, I think the other point you're making is on earnings, and that's a point one can fully appreciate. Q2 is the litmus test, right? Q1 we said there's election, and there are other issues and impediments because of which you could ignore a couple of misses here and there. What is the Q2 expectation you have? And in terms of any sectoral preferences, if you have, do share that with us.
Surabhi, if you look at it, for the full year of FY25, we are building in somewhere close to 13-14% earnings growth. If you look at the Q1 which just went by, there was an 8% earnings growth for Nifty 50 companies at an aggregate level. Now, clearly, the commentary from most of the management was that there were disruptions because of elections and heat waves, and that things will start normalizing from Q2 onwards. And Q2 also will have some impact of the festival season. So if Q2 doesn't see a 12 to 15% earnings growth YOY, then clearly there is a risk that the street will have to start downgrading consensus estimates for FY25. And that could have some sort of ripple effect, because one, you are already trading above mean valuations on indices, positioning is at all-time high levels. And on top of that, if there is some sort of earnings disappointment, then clearly we feel that the markets can have some small pullback from here on levels. In terms of sectoral preference, the last time when we talked about, we had said that banking is one of the sectors that we are positive. Bank Nifty at that point was closer to 51,200, 51,300 levels. We've seen a 6-7% up move in most large cap banks from there on. And we still feel that there's another 10 to 12% upside that one can make in these names over a 10 to 12 month horizon. In terms of cautiousness, we've gone a bit cautious on the IT names. So clearly, if you look at it, the commentary from most large IT players, if you look at it, they are not signaling a significant demand revival from where we were in Q1. If you see the deal will announcements also from most of the large Indian players, we haven't seen much of large deal announcements from them. Typically Q3, Q4 are seasonally weak quarters. If you look at the commentary from Accenture a few days back, they have deferred pay hikes for 6 months. So my sense is valuations we are trading probably one standard deviation above mean, and if earnings trajectory or earnings momentum does not follow for IT names, there could be some sort of selling in those names. In terms of geography, Europe specifically is one of the geography where most companies are saying that they are seeing slowdown. And the second part is if you look at BFSI as a whole is close to 40% of the overall earnings for IT companies. And there, given that there's a rate cut cycle that's happening, the NIMs could get a bit compressed for large banking names in the US. So yeah, we have some sort of cautiousness on IT names going forward.
All right. Hi, Nikhil. Good afternoon and good to see you, Ben. Since you briefly spoke about China, and we have been discussing that the play on China could be metals, but you're talking about the chemical space as well. Do you think that could be the dark horse from here on?
Yeah, so what has happened, Nigel, is over the last 4 to 6 quarters, most of the specialty chemical companies in China, if you look at it, they had set up large-scale capacity and demand was clearly an issue because economic growth had slowed down. And consequently, here also we've seen that over the last 4 to 6 quarters, chemical companies have disappointed. Going forward, the commentary from most of the companies was that prices at least seem to have bottomed out. And so therefore, because markets are typically 3 to 6 months ahead in terms of pricing earnings recovery, if we see data points from China stabilizing, then that's one sector where positioning also is low. And if we get that green shoots of recovery, then specialty chemicals can start doing pretty well from here on. Is what my view is, because they have not participated till now in the rally that has happened in the markets in a big way.
Yeah, right. And you briefly mentioned that, financials are something, banks financials, something that you spoke to us about the last time, and it's done 6%. You believe that it could do well from here on as well. Which side are you leaning to? Do you think the private sector banks now are better place than the PSUs?
So if you look at it, private sector banks have moved, honestly speaking, more than what PSU banks have moved. And so tactically, given that most PSU names are today trading closer to book value, my sense is there can be some sort of catch-up that can happen on the PSU side now. Private banks have already moved 7-8%. And then the street will clearly watch out for what is the Q2 update from most of the companies. In the first week of October, we will have earnings update from most large private banks as well as some of the PSU banks, where we will get to see what sort of loan growth they are reporting. And so my sense is that there is some sort of tactical play that is still left on the PSU bank side. 8-10% up move is something that we feel can come even on that space.
All right, Nikhil, by the way, these are broad sectoral kind of trades, etc. Are you finding enough to do in terms of idiosyncratic kind of moves? Single stock could be a situational thing, or you think those are also they're being very, very, very efficiently priced, getting harder in that sense?
So clearly, Prashant, things are becoming difficult. It's getting difficult to find value in the markets. In terms of specific sectors, something like, the largest power generation company, there's announcement of the green energy IPO. This could be 8-10% up moves that one could tactically play in these names. We've seen that happening with Bajaj Finance also. When Bajaj Finance Housing got announced, the stock listed at almost close to 5 times price to book. And so there was that tactical rally that happened in Bajaj Finance as well. So something of that sort where, so value unlocking is happening in subsidiaries, those sort of trades definitely can pan out because the market is short on ideas, and therefore wherever they see that there's 8 to 10% upside that can be made, people very quickly latch onto it.
All right, we'll leave it there. Nikhil, great to speak with you. Thank you very much for coming on, and thanks for that view. Quite interesting. Now, we're all talking